Hello friends. Welcome to NM India Advises. We are back with our weekly update on tax and corporate laws, covering the latest judicial pronouncements and regulatory changes that can impact businesses and individuals. Let's dive straight into this week's important updates. Starting with the Income Tax Act, the Bombay High Court recently ruled in the case of Commissioner of Income Tax versus Vodafone SA Limited that payments made to call centers do not require tax deduction at source under Section 194J. The assessing officer had initially categorized these payments as professional or technical fees and demanded TDS. However, both the Commissioner, Appeals, and the Tribunal ruled in favor of Vodafone, stating that since no professional, managerial, or technical expertise was involved, the payments did not attract TDS. Under this section, the High Court upheld this decision, confirming that no substantial question of law was involved. In another case, RE Healthcare Private Limited versus Assistant Commissioner of Income Tax, the Mumbai Tribunal held that marketing expenses incurred by a pharmaceutical company towards staff recruitment, salaries of sales executives, and related costs should be considered revenue expenses. Since these costs were directly linked to business operations, they were allowed as deductions. Moving on, in the case of S.J. Surya versus Deputy Commissioner of Income Tax, the Supreme Court dismissed a petition challenging a criminal prosecution under Sections 276cc and 276 of the Income Tax Act. The court observed that even though the tax tribunal had nullified the assessment order on technical grounds, the taxpayer had failed to file returns, pay advance tax, and disclose income properly. Hence, the prosecution was not quashed. Another crucial judgment came from the Hyderabad Tribunal in the case of Ujjwala Developers Private Limited versus Deputy Commissioner of Income Tax. Here, the tribunal ruled that interest paid on customer advances for delayed delivery of flats should be allowed as a deduction. The court emphasized that since the funds received were used for business purposes as per the Memorandum of Understanding, MOU, disallowing finance charges without valid reasoning was unjustified. In a significant development, the Patna High Court, in the case of Takshashila Educational Society versus Income Tax Department, ruled that if a penalty order under Section 270A is passed without considering a pending appeal against the assessment order, such a penalty order must be set aside and reviewed afresh. This reinforces the principle that due process must be followed before imposing penalties. Now, let's look at key developments in Goods and Services Tax, GST. The Delhi High Court ruled that if a GST registration is cancelled retrospectively without proper reasoning in the show cause notice or cancellation order, and the revocation application is rejected without a fair hearing, such actions are invalid. The court emphasized that taxpayers must be given a fair opportunity before such drastic measures are taken. The Calcutta High Court, in a recent case, allowed a taxpayer to withdraw their writ petition so they could avail of the waiver of interest and penalties introduced under Section 128A of the CGST Act. This highlights the new relief measures available for taxpayers and the need to be aware of such benefits. Another crucial judgment came from the Telangana High Court, which ruled that any notices or orders issued by revenue authorities without a valid physical or digital signature of the proper officer are not legally enforceable. The court emphasized that as per Rule 142, prescribed forms must bear a signature, making this requirement mandatory. This ruling strengthens procedural fairness and ensures that revenue authorities comply with legal formalities. In another case, the Delhi High Court ruled that when there is a dispute regarding differences in turnover reported in GSTR1 and GSTR3B, authorities must consider the taxpayer's reply and provide a hearing before passing an order under Section 73. The failure to do so renders the order unsustainable, and the matter must be reconsidered. A landmark ruling came from the Supreme Court regarding the treatment of tax dues in insolvency cases. The court held that if a corporate debtor's income tax liabilities for past assessment years were not included in the approved resolution plan under the Insolvency and Bankruptcy Code, IBC, those tax demands stand extinguished. Consequently, any subsequent tax recovery attempts by the Income Tax Department for those periods would be invalid. This judgment reaffirms the supremacy of the IBC in resolving corporate debts and provides much-needed clarity to businesses undergoing insolvency resolution. Finally, in the case of IDBI Bank Limited versus Gaurav Goel, the Supreme Court held that banks must provide borrowers an opportunity to be heard before classifying their loan accounts as fraudulent. The court ruled that the principle of audi alterum partem, right to a fair hearing, cannot be ignored, and lender banks must ensure transparency and fairness in their classification processes. This decision significantly impacts borrowers and strengthens procedural safeguards in banking fraud cases. That's all for this week's tax and corporate law updates. Stay tuned for more insights and expert opinions on legal and financial matters. Don't forget to like, share, and subscribe to Nanometer India Advisors for your weekly dose of important regulatory updates. See you next time.